Hey y'all, in this video, I'm going to share information I can share publicly about one of the deals that I'm investing in and is also open. If you're interested, you can contact me about. It's going to be heavily tactical, right? There'll be some learning points involved, but this is less of a learning video and more of I want to understand more about this specific deal. So there's not going to be any of the private stuff that I would send. It's not going to include the executive summary or anything like that. This is just going to be numbers. And I'm going to kind of show you how this would look like because some of those executive summaries and operating agreements and terms can be kind of confusing. So this is going to be tactical, but I'm just going to jump right in and we're going to go through some stuff here. So what I'm specifically going to cover is this first deal is projected at a 6-year deal. So I'm going to go through what this deal would look like or what the S&P would look like. And if this is confusing, it's the main thing are going to be the graphs. Okay, the graphs at the end. So I'm not going to spend a lot of time on this. The one thing I did want to mention is the challenge here is predicting the returns of the S&P, right? No one in the world can do it. Otherwise, they would have infinite amount of money. So I looked at some sources here. Goldman Sachs is predicting basically over the next 10 years a range of 2 to 11%. They're estimating 6%, right? In the last 10 years, the S&P has returned about 14%. And like I've covered in a lot of my videos, that has been due to the inflationary environment. I'm sure a lot of people have heard that, QE, low federal funds rate, things like that. So I thought that was interesting because Charles Schwab, similar thing over the next 10 years, 6%. So super close there. A couple other things. This source here had some interesting stuff. Two well-known economists, Tom Lee is expecting at the end of this year, the S&P to be 4,200, Jim Cramer 4,100. So that would mean a price drop from where we're at right now. And the Bank of America is expecting it by 2030 to have a pretty wide range, but it equates to 2% to 14%. So I feel like they kind of didn't put as strong of an opinion on it. So I went with 6% over the next 10 years, which you'll see here. So my calculation right now for the S&P is for the next 6 years, it's going to be 6%. So if you guys are interested in actually investing in this and you have a different hypothesis here, if you're like, oh no, like, the stock market is going to rip next year or whatever, then, just reach out and this will account for those changes, right? So you can kind of see how things would function with different market hypotheses, but just for this video, I'm going to stick with 6%. And the only change here is I'm going to go with Jim Rome. It's the stock market's going to drop a bit, but again, this is changeable. So anyways, what you see here, this is an example of a $100,000 investment. So what you see here is over the course of the next 6 years, if we're averaging 6%, that would give you about 135K in 2029, right? So what I want to go through is one of the funds I'm raising capital for. So I'm not going to share too many details. So it is an investment in a large industrial facility and basically a business that runs out of that facility, highly qualified operators, and pretty high return. So this is a really great deal. I'm excited about. I'm putting quite a bit of capital in here, but so I'm just going to go through some terms that you would see in basically a term sheet. So one is this concept of preferred returns. What that means is that as an investor, if you get preferred returns, that money comes to you before it goes to the general partners. So let's say a deal was expected to make 15% ROI total, and you have a 10% preferred return. If that deal ended up only making 9%, all of that money goes to you before it goes to the general partners. So in any deal, it's a limited partner. That's going to be you. The general partner is the actual operator. They typically invest some money in the deal and they actually run the deal. So a lot of the ways this works is that they put a benchmark of preferred returns. And you should think about that is this is almost guaranteed to happen unless something goes crazy wrong. The reason for that is because otherwise the operator is working for free, right? That would be pretty insane. No one wants to do that. So 10% pref is pretty high. That's how that works. This deal is paid quarterly. Another thing is you'll normally see splits after some amount of time. So a lot of times you'll see a revenue split after the preferred return, like, hey, once you get your 10%, we're going to go 50-50. That's not uncommon. So this one is pretty crazy, is they don't take a split until all of your capital is returned back. So that means so this is a 100K scenario. They don't take a split until all of your money is returned back. So this is pretty insane. This is a very low risk from a term standpoint. And then after you have all your money back, then they take the split where they'll take 75 and the investor gets 25. So yeah, this is 5 to 7 years. The projection is 6 years. The projected cash on cash return is 24%, which is insanely high. And the IRR projected return is 30%. The hypothesis here is that in year 6, they're going to sell this asset. They're going to sell the building. They own the building. And there's going to be some, capital return involved in that. So I'm just going to quickly go through this, where what this is going to look like is if you invest 100K, every quarter you get $2,500. Now it is, I'll tell you, having been in a few funds, this is really nice to see that. It's a lot different than being in stocks where you have massive anxiety all the time. Everything in the news, everything that's happened is the stocks are going down. You're just seeing your wealth go down and down and down. So with a deal like this, your equity can kind of, go up or down or whatever, but you're receiving consistent cash flow distribution. So with this deal, in year 1, you're receiving $2,500 a quarter. In year 2, what you're seeing here is it goes down a bit because there's an expectation that you're going to get a large amount of capital paid back. So almost half of your capital is getting paid back in year 2. Why is that? That's because of this split where this vendor wants to give you all your money back as fast as possible, because that's when they start to make money. And even when that happens, you still have an equity interest. You still get a split, right? So if all of your capital gets paid back in year 2, that's one, amazing, right? Like I said before, typically your best VC firm would look to basically do that in 4 to 5 years. But so for this, that's why they're projecting to pay it back in year 2. All the excess cash flow goes into paying your capital back. So then again, what you're seeing here is in year 3 is when they expect to pay all of the capital back. Okay, so that's why you're seeing kind of a reduced cash flow here, is because you have a high percentage of the profit sharing, but most of the profit is going into paying your money back. Okay, so that's why it's kind of lower. But then what you see in year 4, because all the capital has been paid back, now the profitability is through the roof, right? So that's why your cash flow starts to go up in year 4, year 5, because all your capital is paid back. And then this, I'm kind of conservative. In year 6, you would continue receiving distributions, but I put this in as the hypothetical sale and your percentage of the sale. But in reality, you probably still continue to receive distribution. So the reality of the situation is the projections are probably going to be a lot higher than what this is depicting. So the only other thing I want to go through before I get to the graphs, actually, I'm just gonna go to the graphs because the rest of this is kind of hard to understand. So if you'll just give me a second here. Okay, just gotta move one more thing and then we will keep going. Okay, so now I'm just gonna kind of show you what this looks like, right, relative to the S&P. So you kind of, I hope, kind of understand the fundamentals of the deal, kind of generally how it's going to work. And if you have more questions, there's a lot more information that I can share with you privately if you're interested in the deal. So here's taking a look at your distributions to paid in capital. So if you watch some other videos, that's the actual cash you're receiving relative to what your money would be doing in S&P. So this blue line is the equity you have in the fund, right? So like we said, they're planning on making 2 big payments at the end of the year based on their profitability, paying that all back to investors, right? Because that's when the GPs start to make money. So that's why you see two big equity drops. DPI is what you get back, right? So you can, in this, sorry, this is running DPI. So this is the aggregate amount of cash flow you see back. So, you know, year one, you're getting $2,500 a month. Year two, you're getting about 2K. At the end of year two, you get a big bump, right? This is their projections. You get half your money back in this scenario. Obviously, things could be better, things could be worse. Again, if you want the detailed financials, I give that to you. These are actually pretty conservative relative to what they expect to happen. And then in year three, you can see your cash flow is a little bit less because you have less equity in that. So you have a lower percentage. This is, you know, hypothesizing you get all your cash back in year three, right? Which is crazy. And then at that point, you continue to have an equity interest in this deal that continues to go up. And then at the end, you get, you know, a payback when they eventually sell. And I've got the question, you know, what if they don't sell? If they don't sell, it's still a really good deal for you, right? You're getting, you know, 3 to 4K in cash flow every quarter after having already gotten your money back, right? So that is actually a really good thing. The exit from this, right? The purchase might actually come from the GPs, right? Because they want all their equity back. So if they don't sell, that's actually a really good thing for us. It's a good thing for me because I'm investing a lot in this deal. So yeah, you'd ultimately make about $64,000 more dollars than you would if you were in the S&P estimating 6%. So let's make sure I cover the takeaways. Yeah, how distributions work. So this green is actual cash you receive. In the third graph, you'll see why that's really important. Return of, yeah, right. So return of capital being different than distributions. So your distributions are relative to the actual cash flow and the equity and the profitability of the company. The distributions are paying your capital back, right? Reducing the amount of equity you have in this deal. And again, why some funds want to return early, it's because of the super conservative terms of this deal where they don't start making money until your capital is back. Right. It's pretty crazy. And then we already covered preferred return where, I mean, I don't want to say it's a guarantee, but it is basically if you don't hit the pref, that means the something went horribly wrong, because that means the GPs are working for free, essentially. Okay, so this one is going to be kind of a stack chart just to show you the total value, but splitting up the equity, how much equity is in the deal versus the distribution. So at first you have a lot of equity and you're getting distribution slowly, right? This is your cash flow. And then like we already talked about, two big payoffs. So when you get your capital back, you will have already made about 10K over the S&P in just distributions, right? And you still have an equity interest for the lifetime of this deal. So when they're expecting for you to have your cash flow back, it's better than the S&P here, and you still have an interest in that business. So that's kind of what we see here. You continue to receive cash distributions, and then here's your equity interest here, right? And that's the big payoff. Yeah. So even just cash distributions grow faster than the S&P, which is crazy. And I'll show you why that's crazy in the next graph. Why? Because, you know, the S&P is equity, right? You're not receiving distributions. This, you're running distributions is growing faster than that, which is insane. And I'll show you why in the next graph. And right, we already covered that. Okay, so this is what I'm showing here is if you decide every time you get a cash flow distribution, you put that in the S&P, right? So if you're considering like, I don't know if it's a good deal. What if the S&P rips and does really well? Well, this could be a strategy you follow, right? And when you look at this graph, if you're interested, we can have a meeting and we can go through different scenarios in my chart where if the S&P goes crazy, we can see what this looks like. But so what you're seeing here, right, is in year one, you make about 10,000 in cash. So what this is showing is that every quarter you put that $2,500 distribution into the S&P, and that grows at 6%, right? So you can see these lines are growing much faster than the S&P because it's not only S&P growth, but you're making contributions through distributions. Then, you know, obviously you see your big distribution payback. So what you see here is, you would make another 34K on top of the 200 that we predicted here. It's about 1.7x the S&P. So this is why I wanted to show this. This is why distributions are stronger than equity gain, right? Because you can reinvest that distributed capital in whatever you want. The second thing is, if you were considering a fund against something else, when you have something like this where you receive distributions, it allows you to hedge against the bear case, the bad case for the fund, right? Because as you receive distributions, you can put those in the other thing. So that allows you to hedge where, if the S&P rips and goes crazy, we can go through those scenarios, the fund still wins, right? Because as you're getting your cash back, you put that in the S&P and it still wins, right? And I've done those scenarios. That's why I'm saying that. It's not shown here, but again, we can go through that. But if the S&P does terrible, right, what this hedge allows you to do is you still have your equity, you're still receiving those distributions through the fund. So it's a win-win, and receiving distributions at a regular frequency allows you to hedge against whatever else you're considering. Okay, yeah, so this is the base case, right? So nobody, I invest with a couple full-time investors, right? So if you invest 100K and you're receiving $2,500 a quarter, so the guys I invest with, multiply that by 100, right? Where they're receiving, hundreds of thousands of dollars a quarter, because they've been doing this for 20 years and they did this through the inflationary environment, right? So they're not putting their distributed capital in the S&P, they're putting it in other funds, right? So if this is right, and this fund performs a lot better than the S&P, and a lot of them do, most of them do. I know it's hard to believe, but this is a conservative estimate. This fund could be massively more profitable than that. If that's true, and it is, it's just whether or not you believe it, then when you reinvest those distributions in additional funds, guys, that is how people get massively wealthy, right? That's how you get to the point where, these guys that I invest with are in their 40s, right? A lot of them, and they're receiving these huge chunks of change, a lot of people's annual salary every quarter from passive dividends, and they're just putting that into additional deals, right? That's how you really compound wealth. All right, so I hope that was helpful and informative. Again, this is for a deal I'm raising capital for. This is what I felt comfortable sharing publicly. But if you have questions or if you're interested in this deal, you can reach out. And it is July 8th of 2023, just in case. I don't know how this is going to be shared, but the funding will probably be open for another month or two. So as long as you're in that range, you can actually reach out to me and we can talk through this deal. If not, if it's further in the future, you can check, but it will probably have closed by then. So I hope this is helpful, and let me know if anyone has questions.